How do the banks decide if you can get a mortgage so you can go buy a house, and why do the banks sometimes say no? Because even if you've done everything right, if you've actually got a perfect credit score, there's still less than a 50% chance that your mortgage application turns into money that you can go buy a house with. Hey friends, welcome back to the channel. I'm Ed, an economist and property investor here at Opus Partners. And the most annoying thing about the bank is that you can go and find a house you want. You can go on their website, you can use a mortgage calculator online, plug in your numbers, look at the repayment that you're going to have to make each month and think, yeah, I think I can afford that. You put your mortgage application into the bank, wait a few days, but then boom, the bank says no. Well, not only is that annoying, but it can actually make you feel really bad about yourself as well, because you're like, well, what did I do wrong? And one of the big questions people ask me is, well, how do the banks actually decide whether they're going to give me a mortgage or not? It almost feels like the Wizard of Oz, where there's someone behind a big green curtain pulling some levers and spitting out whether you can get the money to buy a house or the investment property you want. And that's why you need to know that the banks run 3 big tests to decide if you can get that mortgage or not. Do you have enough deposit? Do you already have too much debt? And can you afford the mortgage? Now, if you pass all 3 tests, there's a very good chance your mortgage is going to get approved. If you fail, even on just one test, it's likely they're going to say no. So let's go through each of these 3 tests and see how they're calculated. Jim and Pam are first-time home buyers. They've found love and they now want to buy their first home in New Zealand. Now they hear that they only need a 10 to 20% deposit. So yes, the first test is the deposit test. And if you're talking to a mortgage broker, they're going to call this LVR or loan to value ratio. But let's ditch the geek speak and just talk about Jim and Pam for a second. They've saved some money. They've got it in their KiwiSaver and their deposit totals $70,000. Now, what that means is if they can get a 10% deposit loan, that the bank is going to lend them up to $630,000 as a mortgage, add in their deposit, and they're able to buy a property up to the value of $700,000 just under this test. Now you might say, cool, but not everyone's a first home buyer, Ed, and you often talk about property investors on this channel. So let's meet Michael and Holly. They've owned their property for a while. It's their own home. It's gone up in value, and they want to buy their first investment property. Now, I could show you the numbers on a spreadsheet, but it's just easier to go online and Google usable equity calculator. This is the sort of calculator you're looking for. So let's say that they own just their own property. It's the home that they live in. As I told you, it's worth $800,000 and they've got a mortgage worth $300K. That means that they have got $340,000 of usable equity within their home. So what that means is that with their house, they can go to the bank, borrow some money against their own home and use that money as the deposit for their first investment property. This is what's called the no cash needed method, which I talk about in this video here that you might like to check out. So what can they do with that $340K worth of usable equity or deposit? Well, investors typically need a 20% deposit if they go and buy something that's new, a new build, or a 30% deposit if they buy something that's already been built. That means that Michael and Holly can afford a house somewhere between $1.13 and up to $1.7 million, depending on what they buy. Now, this does not mean that Jim and Pam or Michael and Holly should run out and buy a house with $700K or $1.7 mil, because they've only passed the first test. They've still got 2 more that they've got to get through. And if you like learning about mortgages and property, do me a quick favor, hit that like button. That's how I know whether I should do more of these types of videos for you or not. And honestly, it just helps the YouTube algorithm as well. Subscribing, that helps. We are well on our way to growing this community to 50,000 subscribers. The second test that our 2 couples need to face is the do you have too much debt test. Now, this is a new one. And if I was talking to you a year or 2 ago, this test wasn't around. But then Adrian Orr, our Reserve Bank governor, said, hang on, I'm going to make a new rule. First home buyers, you can borrow a max of 6 times your income. Investors, you're 7 times your income. And if you're talking to a mortgage advisor or a bank, they're going to call this the debt to income ratio restrictions, or just DTI for short. So let's bring back Jim and Pam. Jim earns 80 grand a year. Pam, she's on $60,000. So together they earn 140 grand, which is just above the average in New Zealand. Multiply that by 6 and they can borrow up to $840,000. Now, this part is fascinating. Remember how we said they could borrow 630 grand under the deposit test. And under this test, they can borrow 840 grand under the do I have too much debt test. Now, what is the biggest mortgage they could then get from the bank? Well, it's going to be 630 grand. It's going to be the lower amount, because if they borrow more than that, they're going to start failing on the deposit test. The bank would likely say no. Now, for Michael and Holly, it's going to be different. They're going to buy an investment property so they can borrow up to 7 times their income. Michael, he earns $50,000. Holly, she's on 100 grand a year. And they're going to get 25 grand a year if they buy that rental property, because they're going to be charging their tenant rent. Add that all up, they've got 175 grand worth of income per year, and again, that's before tax. Multiply that by 7, they can afford a mortgage of up to about $1.225 million max. So quite a lot of money. But they already have that $300,000 mortgage and a $10K credit card. So they already have some debt, and that $1.2-ish million is the maximum amount of total debt they can take out. So for an investment property, they can really only borrow up to $915,000 once you take off the mortgage and credit card. So Michael and Holly have the opposite problem to Jim and Pam. It's not the deposit test holding them back, it's the do I have too much debt test. So it doesn't matter that they've got all of this deposit available, because if they try and borrow more than $915,000, they're gonna start failing that DTI test, that do I have too much debt test. And just before we get to that third and final test that you need to know about whether the bank's gonna approve your mortgage or not, if you work for a major bank and you're watching this, you might say, oh, come on, Ed. It's a bit more complicated than all of this. And you're right, just as one example, some properties like new builds don't actually have to follow this new DTI or do I have too much debt test. So if you are Michael and Holly and you're looking at new build properties, then you can just forget about Adrian Orr's new rule. You can just look at the deposit and the last test I'm about to tell you about. But this video, it's not trying to turn you into a mortgage broker with an encyclopedic knowledge of all things lending so you can talk shop with the CEO of ASB. It's just to take you from how the hell does the bank decide whether to give me a mortgage or not to, okay, I've got some idea of some of the things I should be asking. I mean, if you want to dig into all the nitty-gritty details, start listening to the Property Academy podcast. I've recorded over 2,000 episodes with all of those little details. This video here is just to give you the basics, so you're not scratching your head wondering, what's my mortgage advisor actually saying to me? The last test is the fun one because it's the most complicated. It's the can you afford the mortgage test. And if you sit down talking to a mortgage broker, they're gonna call this UMI, or uncommitted monthly income. And basically all it means is if we give you this mortgage, can you actually afford it along with all of the other debts and payments that are going on in your life? And what's important to understand is that the bank is going to stress test your mortgage application under some tough test conditions. So let's come back to Jim and Pam. They want to borrow, let's call it $500,000 for their first home. They reckon that they can get a 5.5% interest rate. So their mortgage is going to cost them $655 a week. They look at themselves and think, hey, I reckon I can afford that. We're still going to have enough money to pay for everything we need to and afford that mortgage. But the banks don't see it that way. They're not going to test your mortgage application and say, hey, can these guys afford it on a 5.5% interest rate? No. They're going to use something closer to 7.5%. And that higher rate is called a servicing test rate. So banks will want to see that Jim and Pam can afford not $655 a week, but $807 a week. That's just over $150 more per week, or almost $8,000 extra a year. And so I often tell first home buyers, look, you don't have to create a fancy spreadsheet like me. If you just go online, find a mortgage calculator, and don't just type in the interest rate that you think you're actually going to pay, bump it up another 2 or 2.5%, because that's what the bank will use when they test your mortgage application. Now, for Jim and Pam, let's say their mortgage advisor says, look, under this can you afford it test, I reckon you're going to be able to borrow $600,000. Now, remember that number because we're going to come back to it in a sec. But first, let's just revisit Michael and Holly, our first-time property investors. Their situation is a bit more interesting because not only will the bank see if they could afford their new investment mortgage at that higher, let's call it 7.5% interest rate, the banks will also do the same thing for their home mortgage. So let's say they've just fixed their interest rate on their home mortgage at 5% for the next 3 years. Doesn't matter. The banks will still say, Michael and Holly, can you afford both your current and any new debt at that higher 7.5% interest rate? But wait, there's more. The banks will also say, well, if you're going to buy an investment property, yep, sure, you're going to get some rent, but you're also going to have rates, you're going to have insurance, you're going to have maintenance to pay. So we're only going to include 3/4, 75% of your rent when we run your numbers and we run this test around, can you afford that mortgage? And hey, you know what else? You've also got a credit card. And I know you haven't spent any money on that credit card, but if we approve your mortgage, you could go and max it out. And at the moment, that's 10 grand. So we're going to pretend like you've already maxed it out when we run your numbers. And oh yeah, I know you've got to take out an interest-only mortgage, but we're going to run these numbers like you're already paying off that debt. And look, I'm not saying that these are bad tests. I'm not saying that the banks are doing a bad job and they shouldn't do it this way. There are actually really good reasons why the banks have each of these little tests, because they don't want to get into a situation where they give you a mortgage and then you actually can't afford it. But it's important to get across that there is a laundry list of little ways that they're going to test your mortgage application to make sure you can actually afford it under this can you afford the mortgage test? And that's why this one is a little bit more complicated. It's also the reason why banks often give mortgage advisors special spreadsheets to run your numbers and check this specific test. They're actually not allowed to send you any of those spreadsheets to play around with yourself. And in fact, I'll tell you a wee story. I once showed one of the bank's spreadsheets on a webinar in front of about 600 Kiwi property investors, and I got a phone call the next day telling me I'd done the wrong thing, to which, of course, you always apologize to the bank. But that is the reason why I ended up working with one of the world's top Microsoft Excel experts to create my own, so I can show it to all of you on YouTube and not get in trouble. Now, when I run Michael and Holly's numbers through this spreadsheet, it looks like they could afford a $1.25 million mortgage for an investment property. And so what the bank will do is look at these 3 tests and look at the lowest number. So Michael and Holly, they can buy a house worth $915,000 if they buy an existing house, because it's going to be the debt to income ratio, the do you have too much debt test holding them back. But if they decide to go and buy a new build, that debt to income test, that do you have too much debt test doesn't count. So they'd be able to afford a mortgage of $1.25 million. Let's come to Jim and Pam. I told you before that they would be able to afford a maximum mortgage of $600K under that can I afford it test. Remember, that's because under the deposit test, they could borrow $630K, $840K under the do I have too much debt test, and $600K, the smallest amount under the can I afford it test. So the banks will take that lowest, they'll give them a maximum of $600K as the biggest mortgage they can get. But don't forget, they still have a $70,000 deposit, so they can go and buy a house worth about $670K. Now, if your head is spinning with all of these numbers, don't worry. While mortgage brokers and the banks will use a lot of complicated language, all you've got to remember is there are 3 main tests you need to pass to get your mortgage approved. And if your mortgage does get declined, it's fine to ask, hey, what's holding my mortgage application back? Is it the deposit test? Do I have too much debt? Or does it just look like I can't afford it? Because chances are it's going to be one of those 3 things. And once you know what it is, you can actually do something about it.